Dan Skelly, the S&P is up around 2% year to date. And before we talk about individual stocks, I want to get your outlook for the second half for the entire S&P, for the stock market.
Yeah, absolutely. We think it's going to be an okay year this year, maybe a 5 or 6% return in total when all is said and done. And that's really going to be in line with where we think earnings can be produced this year. We do think on the fundamentals, when you look at earnings expectations, they have been lowered substantially. So the market is now discounting down 4% in earnings this quarter. We think that's an achievable bar, probably able to beat. The other key point is on the economy. As we all remember, the ports issue, the weather issue, we had a terrible first half of the year. We think GDP is tracking around 2.5% to 3% for the rest of the year. And then lastly, on the headline side, with the Greek issue now hopefully off to the sidelines for now, with the Chinese market stabilizing here, we think headline risk is also diminished, proving to be some potential for upside for the market.
Well, we also had a worse than expected June retail sales numbers, and one of the stocks that you like is Home Depot. It's had a great year so far, up around 9.5%. And over the past 12 months, I think it's up over 40%. So why do you stick with this right here?
Yeah, to your point, Greg, we have seen a tepid retail sales environment overall. Within that, we think home improvement is actually an area of strength. Now, why is that? When you look at the past couple of months and really quarters, you've started to see housing data improve substantially. So May existing and new home sales surprised to the upside. You saw April also revised upward. Housing formations on a whole are looking to be much better. And so related to that, we really think that people have put off big ticket items like home improvement, like renovations, are starting to get more confident and really feel better about the house. So again, retail sales weak, but Home Depot within that, we think an area of strength. Now, some of the other things we've seen, consistent execution. We think they're taking share from some of the other players in the market. They posted 7% comps in their most recent quarter. That's a really good growth rate. And then lastly, great return of capital. For people who need income, they've grown their dividend 17% a year for each of the last 5 years. Most recently, they increased their dividend 26%.
And you're also positive on Comcast. So what does this company do in the wake of the Time Warner cable merger collapse?
Yeah, absolutely.
And a lot of cord cutters out there too.
Yeah, absolutely. So there are some recent issues that the company's seen in terms of that deal not going through. In terms of the core business, it's still intact, right? So we still think it's one of the most visible, high-growth businesses out there. People really don't cut their cable subscriptions even through recessions. This company's grown their earnings 10 years in a row, and that's even including the 08-09 period. So you're looking at double-digit earnings growth at a decent multiple. You're trading at about 16 times a market multiple for very visible, very steady earnings growth. Next, in terms of the capital, as you mentioned, they weren't able to do the big acquisition with Time Warner. That being said, they're buying back a tremendous amount of stock. So we think they can buy back upwards of 10% of their market cap over the next year or two. Lastly, related to that, they have an underlevered balance sheet. Okay, so versus some of their cable peers, they could take leverage up and buy back even more stock. Last comment I'll make about the story overall is NBC Universal. They do have a film franchise which is in strong recovery mode right now. Jurassic World, I'm sure many of us have seen it. I saw it and loved it. It's the quickest $1 billion grossing film in history. And the other franchise that they've done very well with is Minions, $115 million in the box office in the first weekend.
And then finally, Ingersoll Rand. This is a company that moved its headquarters, I think, from Bermuda to Ireland to take advantage of the tax break through the inversion. There's talk that a lot of these companies are not getting government bids because of this move to lower their taxes. So how will that affect Ingersoll Rand going forward? Stock's up, I think, around 6% so far this year.
Right, sure. So that is certainly an issue. But that being said, we think the company's diversified enough to offset that, particularly as it relates to its commercial customers. So government makes up one part of the business, but when you look at the other customer list, commercial and industrial is a big part of the focus. Now, the other reason we like Ingersoll is the North America exposure. They've got 30% exposure to North America non-residential construction. Some of their industrial peers in that space, in HVAC, heating, ventilation, AC, air conditioning, have only 14%. So double the rate of exposure to North America. North America is the area where we're seeing the best non-residential recovery today. Any way you cut the data, permitting, construction spending, et cetera, you're seeing non-residential spending on a high, and that really benefits Ingersoll, who has that exposure.
All right, well, thanks a lot, Dan.
Thanks, Greg.
Thank you for watching The Street.